Good afternoon. It is Desiree Whalen with the Whalen team, and we are speaking about North Carolina buying property here. And I have two guests. I have Sean Martin, who is on the Whalen team, and we are going to be talking about helping you guys purchase property here. And then also we have Matt Barber, who is a lender, and he will be speaking on the topic of lending. So feel free to ask us any questions that you may have. And hopefully what we are providing you gives you a nice baseline for you to understand. And then if you would like to talk further about your personal situation, we will be happy to do that, whether you're looking to move now or 5 years from now. I mean, we just are speaking with somebody now who's been on our site 10 years. So we are patient and we will be here. All right, so let's go ahead and get started on what it's like to buy property in North Carolina. Okay. All right, lifestyle and neighborhoods. How do you choose between areas like the Wilmington area, which is New Hanover, Brunswick County, and Pender County? Honestly, it really comes down to what your lifestyle looks like. I would say if you are looking for convenience, the Wilmington, New Hanover County area is great for that. We have everything here, an international airport, all the shops, all the restaurants. If you are looking for more of a lifestyle community that has everything at beach homes, not beach homes, but beach club houses, houses, the whole tennis court, like a country club feeling, I would say Brunswick County has a lot of them to choose from. New Hanover has a couple. However, I would say majority of them are in Brunswick County. And then Pender County is more of like your typical beach town, where it encompasses like communities like Hampstead, Surf City, Topsail Island. So based on what you're looking for, we can help you figure out which area may be the best fit for you. Now, what are property tax rates compared to other states? So I believe ours are fairly low compared to many, many other states. So here's a good example for you. So right now, I'll take Charlotte and Southport. They have of the Brunswick County neighbor areas, they're the ones with the highest rates. So you pay a Brunswick County rate, you also pay a city rate. Most times you pay a fire department. But let's just take Charlotte and Southport. So Brunswick is 0.342. The city is 0.31, so that is 0.652 cents per $100. And so if you look at a $300,000 home, you're looking at $1,956 plus or minus. So it's not bad compared to some states, which is, $25,000, $30,000 a year. Now, it is based on whether it's a new home or resale. Your taxes are based on the price of that you paid for the new home. Your resale is based on the assessed value. And so you can ask your realtor what that assessed value looks like. What role do HOAs play in coastal communities, and what do HOA fees typically cover? So, really, an HOA lets you do things or not let you do things in those neighborhoods. In the state of North Carolina, you can have short-term rentals, but your HOA may not allow you to have them. HOA fees covers everything from just keeping the front entrance nice looking, that's really about it. Or they will do everything where they are, you're paying for the amenities there. If you are in a condo or a townhouse situation, they're paying for all the insurances in there, maintenance, upkeep, exterior. Each townhome and each condo will be a little bit different, but that's normally what they pay for. Um, And then what seasonal factors should you consider when you are buying something? So I would say really during the hurricane season, which is about now, we're probably in our peak. You just have to be aware that if there is a named hurricane coming, that even though you may close tomorrow, you may not be able to get insurance until that hurricane passes. So I would also say if you're looking for a short-term rental, now is really the time to buy because homeowners are almost done with the season. They're sometimes done with being a homeowner or a landlord, so they want to sell that property and move on to something else. So now is the perfect time to buy that short-term rental now through probably about January, because people are starting to look for the rental communities to buy for rent to short sale them, short-term sell them for that following year. And people start booking them around January, February time.
Okay.
So then, coastal and local considerations. What should I know about coastal hazards like erosion, flood zones, inlet movement before buying near the beach? As part of the information that we are going to provide you, we're going to give you this handy dandy brochure that the state gives us. It's called Purchasing Coastal Real Estate in North Carolina. It's a really nice booklet that we give to everybody once when they move here, or they're thinking about moving here, to read over and look what they probably need to do. But I would say if you are buying any sort of waterfront properties, please make sure that you are talking to your local CAMA representative. They will tell you whether or not your home is rebuildable or not in case of any sort of devastation. If your home, it burns to the ground, you may or may not be able to rebuild that home. So, because there's different setbacks for each town. So make sure you're talking your local representative and you have that conversation, and make sure you're talking them early in your buying time, because they may need to go out there, and sometimes they may not be able to get out there for a week or two or more to tell you whether that home is rebuildable or not. Um, let's see. So I think that's kind of the nuts and bolts of it. But get with your realtor and ask them very specifically, because I have seen people in situations where they have purchased property and then learn after that even though it looks like they've got tons of land to rebuild, they actually don't because of this imaginary vegetation line. So please make sure you're asking. How do flood insurance requirements work, and and what should I budget for? So in the United States, everybody is really considered to be in a flood zone. It really depends on what level you're in. Sometimes you don't need it, sometimes you do. It's all based on elevation. I would recommend you getting flood insurance, whether you are in, if you are not in one, just in case. You just never know. And so, for instance, mine renewal this year was $752. So it's just a factor, an assurance factor for me, and I always recommend it for you too. Are there restrictions on building or renovating oceanfront property, like setbacks, piling, and storm protection features? Yes. Going back to that first question, absolutely there is. If you are if your home was built, in the 70s or 80s or even 90s, the guidelines since then to build have changed dramatically. So part of your property may be in a setback where you can't build anymore. So can your property be moved back if you have to rebuild it, or are you stuck with a parking space now? So definitely check with your CAMA agent. And what's the difference between buying on the mainland, barrier islands, or intercoastal waterways? It just goes back to restrictions, what you can and can't do. There's different insurances, for being on an island, on intercoastal waterway. You all have to pay wind and hail, but you may have to pay for flood insurance because you are right next to the water. So Sean's going to take it over and start speaking on general buying process here.
Yes, happy to talk about the buying process in North Carolina. I know things do differ from state to state. So I guess number one, we'll start with finding your agent, and we hope that you will choose us in our team. But you definitely want someone local, someone who knows the area and can guide you through the buying process, especially if you are not familiar, have not done it before, or if you're just a first-time home buyer. You're going to want to speak with a lender, and Matt can talk about that a little bit further, but you want to get pre-approval so you know what the budget for. You want to look at homes within your price range, things you are comfortable with in terms of the monthly payment. And then you're going to want to do a buyer consultation with your agent. That would be sitting down for 15, 30 minutes, and we would analyze your goals as a buyer. Want to make sure we get everything accomplished that you set out to do. You will need to sign a written agreement in order to view homes in person. That is a new federal law. So we would then go take a look at some homes in person. We would find the one that you like. We would submit an offer. Once we submit an offer, the seller and their representation has the right to counteroffer, and we negotiate terms back and forth. Um, Once we get that all settled, and us as your agents would be negotiating on your behalf, trying to get you the best deal as possible. So we're under contract. That's when the due diligence period begins, and I can talk about that a little bit further. Say that's something North Carolina does a little differently than most states, so it may be unfamiliar even if you have purchased a home before, or if you haven't purchased something in a while, you may just want a refresher on that. So the due diligence period is about 3 weeks, give or take, and that's when you would do all your inspections as the buyer. And we resolve any issues if there's repairs that are needed or things that come up in the home inspection. That's when we would tackle those issues. Um, After that, we would get ready for, oh, you also have the right to withdraw from the contract if you wanted to, but given everything looks good and you want to proceed with the purchase, we would then get ready for closing. So you would wire the money to the closing attorney who works for you as the buyer. And then we would close and record. And once the purchase closes and records with the county, then you're able to take possession. You are not able to take possession until it closes. So happy to talk about those steps in more detail if there's other questions. Far as the due diligence period, so and what rights does that give you as the buyer? So the due diligence period, like I mentioned, begins once we go under contract. You're going to want to have the due diligence money ready to go because that needs to be submitted to the seller once we're under contract. And you have 1 day legally to get that to the seller, or you would be in breach of contract technically. Usually they're willing to work things out. Everyone wants the purchase to go through. So the due diligence money is negotiable. It's same as the purchase price. It's negotiated within the offer. And an easy way to look at it is the seller would want it to be as high as possible. The buyer would want it to be lower because if you were to terminate the contract during that due diligence period, and that could be for any reason at all, or it could be the inspection comes back and there's something in there, there's a red flag, and you decide to back away, you will lose your due diligence money. It's held by the seller, and as long as you follow through with the purchase, it's applied towards the final purchase price. So think of it as a deposit, but it is non-refundable. So if you walk away for any reason as the buyer, you would lose that money. And like I said, it's negotiable for if you're thinking of how much, if we're talking like a $400,000 or $500,000 home, being that typically 1,500, $2,000 range, but the condition of the house also plays a part of that, and something maybe we can talk about further. The difference between the due diligence and the earnest money. So the main difference is the due diligence money goes directly to the seller to hold. The earnest money is held by an attorney. The due diligence money is much more important because if you were to back out of the contract, you would lose the due diligence money. As long as you backed out within the due diligence period, you would get the earnest money back. So the earnest money is held by the attorney, and just like the due diligence, it's applied towards the final purchase price. So it's not additional money you're paying, it's just money you're putting down up front and is applied to the final purchase price. And then, so for the closing attorney, I know some states do things different with the title company. Here in North Carolina, we are an attorney state, so the attorney does all the title work instead of the title company, and the buyer attorney will be working only for you. And they're going to do a title search to make sure there's no liens or encumbrances on the property, and that the seller actually has the right full ownership to transfer the deed over to you at closing. So that's handled by the attorney, and you'll be in touch with the attorney from the moment you go under contract until we close. And we're happy to recommend one or two in town that our clients have worked with in the past and had great track records working for our clients. You want to go to the next slide? So buyer agency, what does it mean to sign a buyer agency agreement and how does it protect me? Good question. So the buyer agency agreement, that clarifies that the real estate agent you're working with is working directly for you and only for you and has no ties to the seller. You want to protect yourself as the buyer. You want someone who can advocate for you, who can guide you through the process. So you want someone working for you. And it also puts legal duties in place. So us as real estate agents, we have a fiduciary duty to put your needs first at all times, put your needs above our own needs as agents. So we are legally looking out for you and for your best interest. And also grants us anything that we discuss is kept in private, and I'm not going to relay any information to the seller or to their agent that could impact your ability to buy the home. So think of that sort of like a doctor-patient confidentiality. Everything we discuss is kept private, and I'm only acting in good faith on your behalf and negotiating entirely on your behalf. So then dual agency, you may be familiar with, you may not. So if a buyer agency is pretty straightforward, buyer agent represents you and only you. Dual agency would be one agent or one firm representing both sides of the transaction. So we like to practice, if that happens, because our team is affiliated with Keller Williams, we like to practice designated dual agency most of the time so that we're representing only one side and the other Keller Williams agent is representing the other side, and we're not both representing each side. Also, this would apply for new construction. So if you walk into a new construction community, a lot of times they'll have a model home up front and there'll be a sales office with salespeople there who work for the builder. Those really, they can't really practice dual agency because they are they have a contract with the builder, so they are working directly for the builder. They can't advocate for you as the buyer if they're also advocating for the builder. And in this case, the seller is the builder. And if you're curious about who they're working for, you can just take a look at the logo on their shirt and you will see they are working for the builder and they're not really going to be advocating for you and trying to get you the best deal for the new construction home. So we do recommend using a buyer agent even when it's new construction. So then that kind of ties in with the last question here. If I just call the listing agent on a home, who do they really represent? So the listing agent represents the seller. They have a contract already with the seller. They've signed paperwork. Their fiduciary duty is to the seller. They're trying to get the seller the best deal possible, and they can't really advocate for the buyer to get them the best deal possible if they're already obligated to get the seller the best deal possible. You can't really negotiate against yourself. In that case, you're acting almost as an intermediary or just a mediator between the two sides, and the listing agent would be allowed to show you the house, but they're not working for you.
Okay. All right. Matt, it is your turn. We talking about financing and costs.
Okay. Can everybody hear me okay?
We sure
Yep.
can.
Wonderful. All right, guys. I apologize. I'm on my phone and I'm blind, so I'm going to zoom in a little bit and I'm going to
Well,
go
if
through
you'd
these
like, I
questions.
can I'll read you the question and then you can
Okay.
answer it.
Yeah, let's do that.
What credit score and documents do I need to get pre-approved in North Carolina?
A great question. Um, so credit score can go all the way down to 580 for FHA loans. We can get you started on an FHA loan with a credit score as low as 580. 620 is sort of what the minimum is on any sort of conventional lending. Um, and as far as documentation goes, what we ask for is income, assets, credit. So we want to make sure that the credit score is what we just spoke about. Then we want to make sure that the income, that we can verify the income. So how do we do that? We take their two most recent pay stub. Well, I'm sorry, 30 days. So the most recent month of pay stubs. So we can see a snapshot of recent pay history. And then we also want to see, depending on how they're paid, if they're 1099 or if they are W-2, if they're self-employed, there's a lot of different ways to document and verify. But typically we will ask for 2 years of W-2s, 1099s, tax returns, so we can verify that income. For assets, we just need to verify that they have the money to cover closing costs plus whatever down payment they want to put down. And in order to do that, what we ask for is the most recent 2 months of bank statements. And then we can verify that they have that income. We've already pulled their credit score, so we can see what their credit score is. And then the math that we do basically is the other part of the credit report is it generates their list of debts, liabilities, monthly liabilities that they have. So we add up those monthly liabilities with the projected housing cost that we're working on for them. And then we divide that by their income. And then that's where we come up with the magical debt to income ratio. And then we're able to kind of look at the borrower's options from that point forward.
Great. Thank you. What typical closing costs should they expect in North Carolina?
So very broad brush. You know, I tell people $10,000 is really kind of, you know, what you want to expect going into it. You know, obviously that's going to change depending on a lot of factors, but I really think it's going to be somewhere in that general area. Um, you know, and the closing costs, what they consist of are mainly third party costs, meaning whoever the lender might be, they're going to have uh, an origination fee or an underwriting fee, commitment fee. All those are the same thing. And every lender calls it something different, but that's going to be like their fee. And it's going to be somewhere between like $900 to $1,200. Um, Beyond that, there's going to be the appraisal cost, which is a third party. There's going to be the attorney fees, which obviously is a third party as well, and they're going to vary depending on the attorney. But again, if we're just using sort of estimates today, I would say somewhere in the vicinity of 1,200 or yeah, $1,200 for attorney fees. And then you know you're setting up your escrow accounts for taxes and insurance. That can be the bulk really of your closing costs, because if you think about you're having to pay 1 year in advance of taxes, taxes could be $2,500. Insurance could be, let's say, $2,500. That's 5,000. But once it's all said and done, you know, again, just a very, very broad brush on it, but it should be, you know, in the neighborhood of $10,000 closing costs.
And to clarify, those closing costs do go or do not go towards the purchase price.
They do not go towards the purchase price.
Mm-hmm.
They are
Okay.
over and above the purchase price, and that, you know, that goes to, you know, again, really the bulk of it is setting up that taxes and insurance in the
Mm-hmm.
escrow account. Um, you know, and what that escrow account does, if you choose to escrow your taxes and insurance into your mortgage payment, it just makes it a very easy, you know, you make one payment every month, and you know your taxes and your insurance are included in that mortgage payment. Every year the taxes renew, every year the insurance policy renews, but you have set up an escrow account and you've been paying it every month, and it just continues to regenerate, and you don't worry about taxes and insurance anymore because it's included in your mortgage payment.
Okay. Are seller paid concessions common here, and how do they work?
Seller paid, and you can maybe speak to this as well, but I have seen that seller paid concessions are a little bit more common recently than they have been in the
Mm-hmm.
past.
I would agree.
And I really am. I'm seeing them on just about every contract that comes through now. So they are becoming more common. The way that they work is, you know, again, like we were just talking about those closing costs. If we're looking at just the big picture, your closing costs are $10,000. If a seller paid, you know, if the seller says, you know what, we'll pay $5,000 towards your closing costs, then that comes off the top. So your $10,000 in closing costs is now $5,000. So it's just a,
Yes.
yeah.
In the listing description, sometimes you will see that sellers are offering closing costs because of carpet or paint or something like that. You can use that $5,000 or whatever amount that they're offering to whatever you want. You're just bringing in $5,000 less
Mhm.
to the table so that you
Correct.
have it in your pocket to do what you need to do with that house.
Yeah. Yeah, and you know, and you know this as you know the process goes along, and you know maybe after the, you know, you've already settled on a purchase price and everything else, and then the you know, maybe the home inspection, something comes up and it looks like, you know, it might require some money to take care of a repair or, you know, something. Sometimes that's when your agent will, or your buyer agent will speak to the seller agent, and they will, bless you, they will negotiate a seller paid concession or closing cost to kind of make up for that.
Okay, great. Thank you. One thing, could you talk about a little bit about rate buy downs? How do those work?
Yeah. It's sort of a new phenomenon, the rate buy down, but I guess one of the most important things to consider when you're thinking about a rate buy down is you are going to be qualified on the original rate. So, in other words, let's say you are qualified for a 6.5% FHA loan. And so you can now look at the possibility of a rate buy down, a temporary buy down. And so what that does is you've got that 6.5%. If you do a 2-1 buy down, that means the first year you're going to have 2 points off the interest rate. The second year, you're going to have 1 point off the interest rate. And the third year and beyond, you're going to be at that 6.5. So you know, two points off of that, you're starting off at 4.5 for the first year, which is pretty wonderful. How that works is that has to be paid by the seller concessions. So kind of going right back to what we were just talking about, the seller has to pay for that buy down, and so the cost of that, I have a calculator that I use, and so I can tell you, the basic cost of that. I can give you a an example actually while we're here to kind of let you know what that looks like. And there's different temporary buy downs. There's a 1 year, there's a 2 year, there's even a 3 year. In this example that I've got here, there's a 2-1 buy down. They are starting at 6.49%. They're buying it down for 2 years. So the first year is 4.49%. The cost to the seller is $12,000 total for that buy down. So the seller pays that buy down. The buyer, reaps the benefit. In this particular option that I'm looking at, they're saving over $650 the first year. I mean, each month they're saving $650 on the principal and interest payments. Second year, $341 every month on their principal and interest payment, and then again that third year and beyond, they're still at 6.49. It's fixed, so there's no adjustments or anything like that.
And in between, they could always refinance, or if not, it allows the buyer to grow into the home, like the price wise.
It does, yeah, and they can refinance. Most lenders are going to ask you to wait 6 months before you refinance, but yeah, I mean, let's say you lock in, and you're at 4.5% that first year, and it's going to adjust after 1 year to 5.5. If, month 8, you look at rates and suddenly they're at 5.5 fixed, it might be worth looking into go ahead and, refi and get that rate fixed. So yeah, the refi is always an option in this particular scenario.
Okay. Up on the next slide is the various mortgage loans with conventional FHA, VA, and USDA. Can you touch on those?
Yeah, sure. Conventional is what we probably see the most of. It's got a lot more options. As you can see, you can do a 10, 15, 20, 30-year fixed term. You can do an ARM, which is an adjustable rate mortgage, you can do 5, 7, 8 to 10 year arms. The way the adjustable rate mortgage works is it's fixed for those first 5, 7, 8 to 10 years, and then it starts to adjust to whatever the interest rates are at that point. Nobody knows. Again, it's one of those things where the arm, and it's starting to come back, actually, is beneficial because it's a lower rate, and it kind of gets you in the house, and you can refi down the line, if it looks like a smart move. But conventional, you can go all the way up to first-time homebuyer programs. You can do as little as 3% down. They typically, they want to see at least a 620 score. Your credit score can go anywhere from, really 500 all the way up to 800, 840. And your credit score is going to really determine sort of what interest rate you're going to get. It's going to, strengthen your file. So there's a lot of financing options with conventional, and you can do really on all these loans. You can finance a single family home, you can finance a townhouse, condo, a duplex. So really across the board, they're all the same there. FHA, the reason that I like FHA for some borrowers, the rates are lower, considerably lower in some cases. For instance, today, if we're looking, FHA is actually, almost a full point lower. Actually, today there's actually a 5 in front of it, 5.99%, whereas the conventional stuff is closer to like 6.75. So, love FHA because of the low rate. Love FHA because of the low down payment. You can pay, your minimum down payment is 3.5%. And so I think it's a great option for a lot of people, first-time home buyers or not. You don't have to be a first-time home buyer to use an FHA loan. You can do a 15 or 30-year fixed rate, and there's also that 5-year adjustable rate that I was speaking to earlier. USDA, 0 down payment. So that's pretty darn wonderful. The one thing about USDA is that sometimes it's putting a square peg in a round hole, because they have very low debt to income ratios. So it's sometimes very hard to qualify for USDA. But if the borrower does qualify for the USDA, the other main determining factor on a USDA loan is the property itself. Property itself has to be, quote unquote, a rural property. And so the USDA website actually has a map where you can see, check and see the property itself and see if it is USDA eligible. And they can do, again, 0% down. So it's a beautiful thing if we can get all the parts to fit. The VA, speaking of 0 down payment, also 0 down payment available on the VA loan. The VA loan is determined by the borrower and their service. So they must be a veteran or an active duty military. But the 0 down payment's great. The rates are very low on FHA, VA, and USDA. And there's no mortgage insurance on the VA loans. So definitely, the VA is probably the strongest loan out there, I think. Obviously, you must be a veteran or have military service background in order to get it. But if you are eligible for a VA loan, it is an incredibly strong loan, and we have access to a ton of those products.
And you're not restricted to putting 0 down. I've seen VA loans where people are putting 10, 20% down. Is that an accurate statement?
Yes, absolutely. Yeah. Because for some people, the real driver is what's my house payment going to be? And if you
Mhm.
put zero money down, then your house payment's going to be a lot higher than it would be if you've got, let's say, 20% down. So yeah, no, the VA, you don't have to put zero money down, but that option is available, and a lot of people do take advantage of that.
Good.
Yeah.
And then the next slide, you've touched on most of this,
Hmm.
is your next slide of income, assets, employment, and credit, what people can qualify for or
Yeah,
have.
I kind of did. I sort of did touch on a lot of this, but
Yeah.
well, so what I would say is like on income, just to kind of expand on that a little bit. Um, if the borrower is W-2 and they are, salary, they make X amount of dollars every month, they have their W-2s, then that's very, very simple. If the borrower is paid by the hour, then what we have to do is we have to take basically like a 24-month snapshot. We take 2 years of tax returns, and I have kind of a handy dandy calculator that I use to average out what their income is. So self-employed, same thing. It just basically takes a 2-year history of whatever their tax returns are, plus whatever 1099 or W-2 might be involved, and then we'll just do a little bit of a calculation, and then we come up with that number and get back to them. I see rental income on here. If you have been renting, we want that. We want a 2-year history of that. We want a 2-year history of your income. We want a 2-year history, of the residence. So doesn't have to be rental if you bought a long time ago and you're living in a house. We have to have a 2-year, background of that. So, credit looks like I kind of went over that. Good credit
Mhm.
profile equals better rates. Again, like I was saying, that your rate's going to or your credit score is going to dictate, where your rate goes.
Okay.
And so go ahead.
No, I'm just disagreeing with you.
So what I was going to say, sometimes, and like you said, you've got a client that you've been working with for 10 years. Sometimes I'll speak to a client, and a client will not have great credit, right out of the gate. And so I've got some tools at my discretion here that I can kind of go in and take a look at their credit report. I can sort of do a what if scenario. What if we pay this credit card off, or what if we pay this credit card down 50%? How is that going to make that credit score fluctuate? So a lot of times I'll talk to somebody who might be like a 600 credit score, and instead of saying let's get you into a home, I say let's work on strengthening your credit score, and then we can start looking for a home. And so sometimes it could take 6 months, sometimes it can take a year. But I definitely am more than happy to help someone build up their credit profile.
Excellent. Well, thank you, Matt. So at the end of the day, everybody's situation is a little bit different. So just make sure that you guys are speaking with, a lender, just to make sure that what you're wanting to pay each month is what you can, is doable. So. We're almost through here. So inspections and due diligence. So inspections and due diligence. What inspections are most important for coastal homes? Wind, hail, termites, moisture, septic. So really your two basic inspections are your home inspection and your termite inspection. Once we get that home inspection, then we can kind of determine if there's other inspections needed. Let's just say the HVAC doesn't seem right. So there's something structurally that we're finding, and we need to find out some documentation on that. Electrical. So we'll get others based off of that. Others is if you have a septic or a well, we do a septic inspection where they'll put a scope in there to make sure that there's no trees or damage to the septic. We do a well just to make sure that it's clean, that there's no bacteria in that would be harmful. How does a buyer negotiate repairs in North Carolina, and what is typically expected from the seller? So in the state of North Carolina, the seller is not required to repair anything. You are buying the house as is. However, it still gives us the option of doing the inspections and doing a couple of things. You either ask for repairs, you ask for and/or credit for those items, or live with what the home inspection comes back with. Most times listing agents will say, look, you're buying this house as is, we are not doing anything further. Or they say they will be negotiable with what we bring back. So it is highly advisable to do that, even on brand new homes. Goodness gracious, please make sure you are doing your home inspection on your brand new home, because the builders are relying on third-party vendors. So it is very important that you do those. Should I get a survey done? Even if the property has one on file? Yes. If that property didn't have neighbors before, or your neighbors decided to put up their own fencing a couple years later, absolutely. Because if on that survey, if we find that their fence is encroaching on your lot, let the homeowner deal with that before you move in, or you might be okay with it, but it is something that you need to deal with at that moment, really not after. Or if you want a fence, you most definitely need a survey. So this is our last slide. How can I avoid wire fraud when sending money for closing? Never, ever wire money to an agent. Or if an agent says, hey, here are the new wiring instructions, you always get those wiring instructions directly from the attorney's office. And before you wire the money, you call the attorney and ask them, hey, are these the wire instructions, and give them that, and they will verify those for you. Because honestly, once that money goes somewhere else, it's 99% gone. It's gone. If you wanted to do a cashier's check, you would have to get that cashier's check to the attorney at least 2 weeks or more in advance so that it cashes. So if they accept it. What happens if the property is damaged by a storm before closing? Then what we do is figure out what is wrong with the property, what damage it is, and then have that fixed before you close. Can I still buy if I live out of state and can't attend closing in person? Yes. Especially if you're paying cash, you do not need to be here at all because everything is done electronically. If you're getting a loan, you just have to let us know up front, so that, because it does take several extra days to do what they call, what do they call it? An out of state. Well, you're just not in person.
Mail away.
Mail away. Thank you. Goodness. Yeah. So if you're going to do a mail away closing, we definitely need at least another 5 to 7 days to prepare for that, because they send it to the attorney works on it and then sends it back to the lender, and then it gets sent back to the attorney, and then they send it to you. And so if there's any mistakes on there too, it gets sent back. So it's easier if you're here, but it is workable if you're not. Okay. Questions. I believe, Teresa, you had a few questions. You just have to unmute yourself.
Okay, can you hear me now?
I can, yes.
All right, I have a ton of questions, so if I run over,
right.
just tell me you'll call me later and we can go
Okay,
through them.
absolutely. We sure can.
Okay. I think I want to go back to what you said about taxes, Brunswick
Yes.
County, because I live on Oak Island. So
Mm-hmm.
you mentioned Charlotte, Southport,
Mm-hmm.
uh, but how does that compare to Pender County? I'm just curious, the tax rates, or is that something I can find
I can
online?
send that to you. So I
Yeah.
have a list of I have a list, and on that list it's divided into Pender, Brunswick, New Hanover, and Onslow counties. And then it's broken into each county and then the city. So I'm happy I can send that
Oh,
to you.
oh
Mhm.
yeah. Because all right, that'd be awesome. Um, let's see. Okay. Oh, I'm just curious. I know
Mhm.
here on Oak Island, the prices have almost tripled.
Mhm.
Um, and gosh, in the last probably 6 years, 8 years,
Mhm.
the prices have not gone down.
Mhm.
Um, but they're sitting on the market 30 days longer, but
Mhm.
they're still selling at these extremely high prices.
Mhm.
Um, so I'm just wondering if I were to sell my house, I'm looking at Pender County. Let me just let everybody on the phone call know. So I met Desiree in 2005, 2006 when I was living in Cary, North Carolina, and was looking for a condo in Wilmington. So she sold me the condo under construction. Then I think it was, I don't even know, 2019, 2000, maybe around then we sold the condo.
Mhm.
But in the interim, I bought what I thought was my retirement home in 2013 in Oak Island. I've been here 12 years. Can't believe that. But I'm wondering, what are the typical commission rates to sell my house and to buy a house? Or is that set by the state, or is it negotiable with the agent?
It is the simplest is negotiable. Online, I can speak with you personally one on one about
Yeah.
commission, but since the rules have changed federally,
Mm,
I can't mention those to in the public because it's negotiable. So what
okay.
we can do
Okay.
is we can talk about those offline and kind of give you different scenarios on how that works.
Okay.
But in the United States, just everybody you know, the our compensation is 100% negotiable.
Okay, good. And how do I find my local CAMA representative? Because
You
you
go on to
mentioned,
CAMA. Yeah, well, luckily yours
okay.
is on the island.
Oh,
But you just
somebody,
type in
okay.
CAMA representative. You just type in CAMA, and they'll have a list of
Okay.
everybody from the different
Okay.
counties. Hmm.
Okay. And who pays for the home inspection cost? The seller or the buyer?
The buyer.
Okay. That's what I thought, but I wanted to confirm.
Yeah.
Um, hold on. Okay. Okay. Hold on. You answered most of my questions, you and the other two gentlemen. When
Yeah.
if you're a dual agent, can you still be a dual agent? If
It
you're
is. Go ahead.
like, if you sell my house in Oak Island and I buy
Hmm.
a house in Hampstead, can you still be a dual agent? How to,
So if I'm understanding it correctly, I would work with you as your listing agent. in your Oak
Right.
Island home. And then when
Right.
I would be working with you in Pender County to help you find a property, I'm your buyer's agent. So
Okay.
it's two separate agreements. The only time
Oh,
dual
okay.
agents, yeah, so the only time dual agency would come into play would be if Sean wanted to show your house on Oak Island,
Yeah.
and he brought the buyer and they wanted to submit an offer. That's when
Right.
dual agency would take place, or if I brought you the buyer.
Okay.
And that's your comfort level. If that is something you did
Okay.
not want to happen, we could always ask our
Right.
broker in charge to be on
Okay.
the buyer side.
Okay. So, a lot of the information I got here today, it was very good information. It talked about
Good.
lending and loan, but my plan would be, because I don't have a mortgage. I haven't had a mortgage since 2016. So
Mm-hmm.
I would sell and then pay cash for a
Mm-hmm.
new home, let's say in Hampstead, Pender County.
Mm-hmm.
So this is a conversation I think, Desiree, that probably would happen offline. Is
Yes, because there's definitely, as you're talking about it, I'm like, we got to consider tax consequences, if any,
yeah,
what all that looks
eh,
like for you.
just the timing. Like, do I put
Yes.
my house on the market, sell it, take that money and throw it in a whatever CD or something for 30 or 90 days until I find my new house in Pender County? Like, kind of what are the logistics of the
Yeah.
time? But you can call me, just email me and set up an appointment to talk about all that.
Okay, we can do that. Yeah, because
Okay.
that's definitely a lengthier conversation.
Okay, good. Yeah, for sure. Oh, what are y'all seeing as selling agents for contingency offers?
People are accepting them more
Oh, they
often.
are.
They are. So you still have those hot properties. You still have those properties where they're just priced right in the right location, and people are still putting multiple offers in on them. However, that has severely gone down over the last year because there's
Yeah.
definitely more property on the market.
Okay.
So, but most sellers are agreeable to it if you have your house on the market, or more, they're more agreeable if you have it under contract.
Gotcha. That makes
It real
sense.
Yeah, it really just depends on that seller situation. Mm-hmm.
Okay. Um, how do you, as a potential buyer in Pender County versus living in Oak Island, Brunswick County,
Mm-hmm.
is there a way to request or compare utility costs? Because I asked that, and tax assessments. I asked that
Mm-hmm.
because um, here at Oak Island, we have, I pay, of course, Brunswick County taxes, but then locally, I pay minimum almost $87 a month for water and sewer.
Mm-hmm.
When I moved here, it was 123 minimum. I had no
Mm-hmm.
clue. I about passed out when I got my water bill. And
Mm-hmm.
that's for like 2,000 gallons of water. And
Mm-hmm.
then because Oak Island just completely screwed up the sewer assessments and
Mm-hmm.
all that stuff, like, good God, 18, probably 17, 18 years ago. It was a bad contract. It went 400% over budget. And we homeowner taxpayers now have a $620 sewer assessment tax. We have a $220 sand tax. We have a fire tax of $475, which I'm happy to have. And we have a Dozier hospital tax, which I'm happy to have. So how do we compare like utility cost? Is that information accessible if I'm a potential buyer in Pender County?
It is. It's
Okay.
usually on their website. So if you go to the town's
Okay.
website,
Yeah.
they will have all of that.
Like type in the address or whatever.
Well, not necessarily the address, but just what those expenses are and what is required for you. And we
Okay.
can also help you with that too. So we can certainly
Okay.
dive in and
Okay.
get that, make it a little easier.
Okay. So to find my CAMA representative, I would just go up to the town hall and ask them.
Right. And now if you
Okay.
are you though, you don't really need one unless are you going to be on a body of water? Like are you moving to like another island like Topsail? Or are you going to be
No,
more in
no, no, no.
Hampstead?
I want to get off of the water because of
Okay,
the
so if you're in the
in
mainland, you
town.
don't need to get to work with your camera.
Oh,
that is
okay.
really for your if you're going to be a
Waterfront.
waterfront. Mm-hmm.
No, I want to get off the water.
Okay.
Yeah.
Yeah,
All right. Email me and let's set
I
up
will.
a call.
Well,
Thank you
thank you,
very much,
Teresa. I
everybody.
so appreciate you being here and asking these questions. And I'm glad that you felt it was useful. So I know
Oh,
you
I
would tell
did.
me if it wasn't.
Yeah, exactly. Oh gosh. Yeah, you've done good by me for, oh my God, how many years now?
Well, I appreciate it. A long time.
Yeah,
Long time.
since '06.
Yeah. Since now
Yeah.
my son is almost 19 years old.
Oh my God. I can't believe it. And I remember
Yeah.
when you were pregnant with the kids. Oh,
Yeah.
geez.
Oh,
Well, thank you and your team. I found this very, very informative. I appreciate it.
well, thank you, Teresa. I appreciate you too. All right. Well, we are going to move forward and we will send this to everybody who is on our list and make this available on YouTube for others to share. And please feel free to share this with your friends and family if you find this useful. All right. Thank you, everybody. And thank you guys for participating in this.